Welcome back. It's no longer news that JP Morgan has said it will phase out Nigeria from its bond index by the end of October, warning that currency controls introduced by the Central Bank of Nigeria in recent months were making bond market transactions too complex to meet its rules. The investment bank says some bonds will be removed by the end of September and the rest by the end of October. It's no doubt bad news for the Nigerian economy, which some analysts warn could head into a recession by the end of this year, following a back-to-back negative growth. Now, the Central Bank of Nigeria, the Ministry of Finance, and the Debt Management Office have issued a joint statement saying JP Morgan was not fair in its action. The three institutions insist that the basic reasons given by JP Morgan for its action were not tenable. The Global Investment Bank had said it took the decision to remove Nigeria from its index for three basic reasons: lack of liquidity now for transactions, lack of transparency in the determination of the exchange rate, and lack of a fully functional two-way forex market. But the CBN has debunked those reasons, putting forward its own argument and saying whatever actions it has taken has been in the interest of Nigeria and Nigerians. I'm now being joined on the program to discuss this issue further and take a deeper look at the implications of Nigeria getting kicked out of the JP Morgan index. Joining me right now is Mr. Johnson Chukwu, who is the MD of Carry Assets Management and also a financial analyst. Thank you very much for joining us on the program. I mean, we all saw this coming. Some time ago, we talked about this, and you were pretty sure that this was going to happen, so it's no surprise at all. But how bad is this for Nigeria?
Well, I wouldn't say it's not a life and death issue. It's basically weakens our financial standing before in the eyes of investors, foreign portfolio investors. But the key thing for me is how we respond as a country. What policies we're going to come up with to address the weaknesses that have been thrown up by the withdrawal of Nigeria from the JP Morgan government bond index emerging market.
Okay, because you're talking about how we respond. How do you think we should respond? And do you think we've started responding the way you would expect us to respond?
Well, I don't think so. I don't think we are responding appropriately. For me, what matters is what are the cocktail of policy decisions we're going to take to address the issue that will be thrown up, like I said. The issue is not, we're not in any contest with JP Morgan. I don't think the issue is whether they have a right to remove us or whether we are running the right economic policies. The fact is that there's no doubt that our forex market lacks liquidity today. You don't have a two-way quote. You cannot easily go and buy a dollar for investment in any fixed income instrument or repatriation of fixed income sales proceeds or even equity sales proceeds. These are realities that we have on the ground. Of course, we know why those issues came up. We know because oil price has come down, oil price is trading in the 40s, and we do not have as much foreign earnings as we used to have. So we had to put in place some structures to moderate the volatility in exchange rate. But having said that, it is a fact that Nigeria has been ejected from the JP Morgan government bond index emerging market. For me, the government should now develop policies that will help reinflate the local economy. Today, one of the critical things that has happened is that Nigeria now lacks the tool that you use to stabilize your foreign exchange in the event of fluctuations or instability. And that too used to be that if you have a lot of foreign portfolio interested in your fixed income instrument, at periods when you have unstable exchange rate or when the supply of your currency is low, you jack up your interest rate, your local currency debt instrument rate, and then foreign portfolio investors will scramble for that and then inject liquidity into your system, and that will stabilize your exchange rate. Today, we no longer have that way with her. So it is no longer a case of using exchange rate to control inflation. It is no longer using interest rate to control the inflow and outflow of foreign portfolio investment into the economy and stabilize the exchange rate. What we now have to realize is that the supply of foreign exchange will now be largely limited to our oil proceeds And if that be the case, we now need to review the strategy we have used to manage our local currency liquidity.
Let me just ask you this, because whether we like it or not, people on the street want to know how this affects them. So can you just break this down now to the understanding of the common man on the street? How exactly does it affect him?
Well, what basically happens to the common man on the street is that with the exit of foreign portfolio investors from the market, interest rates will go up because the supply of debt instruments will now be higher than demand. So, and basically demand will be only limited to local fund managers. Interest rates will go up, so government will borrow at a higher rate. When government borrows at a higher rate, any fund manager, including banks, will rather give money to the government instead of giving money to the private sector. So what you do, what happens is that you have what you call crowding out effect, because investors will go to the less risky borrowers than the more risky private sector borrowers. So interest rates that will be charged to real sector operators will now be very high, and that means the cost of doing business in Nigeria will go up. The cost of production will go up because the interest cost is part of the integral part of the cost of doing business, cost of production, or cost of goods and services will go up. It then means that for the average person on the street, his income will no longer buy the same volume of goods and services he used to buy. What happens is that because you're having an uptick in cost of goods, which will lead to an uptick in inflation, and the uptick in inflation will lead to a reduction in the standard of living, because the availability of resources at the disposal of ordinary man on the street is no longer enough to command the same volume of goods and services he used to command. And the second thing that will happen is that because that will lead to slowdown in demand, producers, manufacturers, retail outlets will now begin to whittle down the number of employees. So you might see an increase in the level of unemployment. These are the way it will affect the common man on the street. You're going to see increase in the level of unemployment. You're going to see a reduction in the volume of goods and services being produced locally. And that means that the cost of those goods will go up. Two, the need for labor will come down because they're no longer producing as much, because the demand is no longer as high as it used to be. So you're going to see two issues: increase in consumer price index, which is what they call inflation. Two, increase in the level of unemployment. And three, which is an offshoot of the increase in the lending cost that the government will borrow, is an increase in lending costs to private sector operators.
No doubt, the common man has a lot to lose, and people just must understand that. Now, let's look at, how to address this. I mean, there have been suggestions out there. You, for instance, talked about the government needing to reflate the economy. There have also been suggestions that, one of the things that the government should be considering at the moment is probably to devalue the naira further. And some people have said, look, at the current rate at which the naira is exchanging to the dollar is quite high. And now there are suggestions that one of the ways the government could get out of this is probably devalue the naira further to, say, 223 naira to the dollar. And of course, there have also been other suggestions as well. You think that's the best way to go?
Well, the issue of devaluing the naira is just one of the options, but there's a critical option, which is what I think the government should be looking at, and that is the issue of reflating the economy. And for me, today, we can no longer use the inflow of foreign portfolio investment as a way of stabilizing the exchange rate. Two, the exchange rate in Nigeria today is no longer driven by a free market, open market demand with two-way quote. For every demand for FX must be backed up by a justifiable approved payment with the central bank will allow to approve. So today, exchange rate is largely managed by administrative fiat, administrative structures put in place by the central bank. What that means is that we can now assume that if we inject additional liquidity into the system, into the economy, that additional liquidity will not be pursuing the limited available foreign exchange, because you must have underlying transaction before you demand for FX. It is not like a free market environment where you can actually have your naira and then buy up FX and hold. So if that is the case, then the government can no longer use as an excuse that we want to manage the exchange rate to continue to keep cost of funds high. And what the government should do at this point is to encourage the Monetary Policy Committee that we're meeting towards the end of this month to reduce the cash reserve ratio of banks from 31% to maybe 10%, 12%, 15%.
Of course,
if you do that, you are going to inject a lot of liquidity to the system. That liquidity will help depress the cost of borrowing and depress the cost of lending to the government, both the government and the private sector. At a lower cost of borrowing, the real sector will begin to edge up their production activities. And that will also help depress the cost of goods and services in the economy. So for me, it's time to use both fiscal and monetary expansionary policies to inject liquidity into the economy and reflate the economy so that the real sector will have access to funding and begin to borrow and then go back to productive activities. And for me, that should be the primary objective of the government at this point.
So for this, I mean, for the CBN and the Monetary Policy Committee, this is certainly not the time to tighten further.
Absolutely not.
Hello, Mr. Johnson Chukwu, if you can hear me. I just asked.
Yes, I said absolutely not. It's not a time to tighten further because I always say this, managing the economy is a satisfying objective. You are not going to continue to say you want to maintain exchange rate stability, you want to maintain low inflation rate, at the expense of the core factor you be driving, which is to increase the level of employment, to increase the level of productive activities in your economy, and reduce the misery index, and reduce the level of poverty in the economy. The government should be considered as a priority. I don't mind if Naira devalues slightly further. I wouldn't mind if we see a bit uptick in inflation, but what matters to the government should be we should create employment, we should reflate the economy. Today, the economy is growing at about 2.35%. Remember that our population is growing about 3%. It then means that gradually we're going to be seeing an increase in level of poverty. Because if your economy is growing at a rate that is less than the growth of your population, you're actually going to be having more and more people getting poorer. And government should be cautious of that.
How much of this can we blame on the non-appointment of the cabinet? I mean, Buhari's cabinet. Up till this moment, we still do not have a cabinet in place. And, you know, people have said, look, if there was an economic team in place, for instance, probably we wouldn't be having some of this problems. So how much of this can we blame on that?
Well, what I would say is that it may not necessarily be that we won't be having any of these problems. It may just be that we would have had a group of people whose primary job is to address the issues that are coming up, who would have actually come up with policies that may have moderated the impact or even prevented some of these things from happening. But the key thing is this: when there is nobody whose primary objective is to focus on the economy, you are likely going to see slips here and there, but the fact is that some of the problems we have are exogenous. Exogenous in the sense that they are external to us, like the issue of crude oil price. The only thing that we need to do is ask ourselves that, are we having the appropriate response? And you cannot have that appropriate response if you don't have somebody who is focused, whose primary duty it is to focus on that, on the economy.
Absolutely. Let me just ask you this now. Of course, JP Morgan has said, well, this expulsion, of course, we all know is not immediate. It takes place sometime in October. Between now and that time, do you think there's anything this country can do to stave off this expulsion?
No, I don't think so. I don't think there's anything we can do at this point in time. It is not very likely. It's almost definitely unlikely that the central bank will try to inject liquidity into the FX market. If they do that today, you're going to see a reserve drop to less than 20 billion, and that will create panic. I think the reformation that we'll be looking at will have to be a gradual process. We already have built up demand for foreign exchange. You are going to have already portfolio investors in the equities market and the fund and the fixed income market that want to exit. Those who are following the JP Morgan government bond index emerging markets, they are likely going to exit your market. Any attempt today to stave off that ejection will create additional havoc on the economy. So I think we have to live with it for now, but the government should prepare to make sure we are readmitted in the next 12 months. The condition they've already told us that even if we restore liquidity into the FX market, they're going to still observe us for the next 12 months before they readmit us.
Yeah, and that's the problem, because now that we're out, I mean, basically from what you're saying now, we're out technically. It will take another 12 months before we're back in. That is if we did the right thing. Yeah.
Yes, but the key, like I always say, if we have the appropriate mix of fiscal and monetary policies in place, in the next 1 year, one of the things we should be looking at is this. How do we drive an import substitution economy? It is not enough to place restrictions on the type of goods or the volume of goods or the categories of goods you can bring into the economy. There must be a supporting policy that will drive production of those goods locally. If you do not produce them locally, you are going to basically holding back your citizens' consumption until they have the privilege to go back and consume those things. But if you have substitutes locally, that is only time when restrictions on importation of certain goods become valuable, because it gives you a window to grow your local substitutes. If we do not have a policy that will encourage local production of those goods and services that we say that no longer qualify for FX, then we have not achieved anything. And that's why I'm focusing on how do we bring down cost of borrowing so that the real sector will actually begin to do business. There's no way the real sector will be viable in an economy where the government is borrowing at 17%. Because by the time you add the risk premium, you should be talking of real sector operators borrowing at about 25%. And it will take it will be very difficult for you to have a productive activity that will be able to meet interest payment at 25%, unless you're talking of trading activity that has a short access conversion cycle. If you have an access conversion cycle of 60 days to 90 days, you can actually borrow at 25%. But if you have an access conversion cycle, which means the time it takes you to start your production and the time it takes you to sell those goods and regenerate cash of 180 days, you are not likely going to succeed in paying 25% interest rate and still be profitable. So we should drive down the cost of borrowing. We've seen countries that have done it successfully. We've seen US. The Reserve Bank of US was actively engaged in quantitative easing for almost 10 years. And the US economy is now growing and adding about 145,000 jobs every month. We need to copy from such policy initiatives.
And too bad for local manufacturers here, because just the other day they had their own press conference. I'm talking about the Lagos Chamber of Commerce and Industry, where they came out with a position that it appears local manufacturing is now in recession. And of course they are complaining over this forex policy of the CBN.
Yes, absolutely. Unless because now they can access their raw materials, and there is no initiative now to make sure that those raw materials are produced locally. For that to happen, cost of borrowing must come down to a level that can be sustained, that productive activities can sustain.
All right, Mr. Johnson Chukwu, thank you very much for joining us on the program. Thank you very much for your contributions. Well, let's just hope this issue is resolved. We just see how all of this pans out. But the most important thing is we want to see Buhari appoint his cabinet as soon as possible, so that the economic team can actually get to work and, settle down to address the economic problems confronting this country. That's it on the program. If you want to watch it again, it's very simple. Just go to our website, tv360nigeria.com. You'll find the program and lots more there. You can also watch us on YouTube by subscribing to our YouTube channel. It's actually youtube.com/TV360 Nigeria. Or you can just follow us on Google+. That's at TV360 Nigeria. Like us on Facebook. The address is facebook.com/TV360 Online. You can also follow us on Twitter. Our handle is at TV360 Online. Thank you very much for watching. We're back again next week. See you then.